So the next thing we have is the over-the-counter market and the exchange-traded markets. So derivatives can be traded on over-the-counter market and also on the exchanges. So anyone who knows what is an OTC market and what is an exchange-traded market?
Yeah.
So what is an OTC market?
I'm not sure, to be honest. I don't know.
Okay, anyone, any idea? Because this is important. You know, this is what I'm saying, that this is our learning. So anyone who has any idea, don't worry about it being right or wrong.
Yeah, I'm not too sure about this one.
Okay, so how many times you have exchanged your currency? I mean, like, you know, if you have another currency and you have gone to the post office or the bank and you have converted your dollars into pounds.
Quite frequent at the airport, or you just do it online?
So when you go there, what do they have? They have this bid and ask for you, isn't it? They say if you want to buy dollars or sell dollars, this is what the price at which we will buy, and this is at the price at which we will sell you dollars or pounds, isn't it? That's what they say.
Yeah.
So why we call it the OTC, over the counter market? Because the dealer is sitting on the other side of the counter and you are on this side of the counter. You cannot negotiate the price with the dealer. The dealer has his bid ask spread for you, isn't it? And you just go and give your pound and get dollars, or give your dollars and get pounds, isn't it?
But normally,
So
if you're changing a certain amount, then you can negotiate. Like if, let's say, you're changing for quite a lot of money, then the rate that is on there, they don't actually give you that. They give you like something better.
yeah, we will talk about it like when we go to the third market and the fourth market and the fifth market. Which book you followed when you were doing your portfolio management course? Was it Rayla and Brown?
No, it wasn't that one actually.
Okay, so what I recommend you to do now is actually, after the lecture ends, you go and you read about the third market, the fourth market, and the fifth market. Okay, you might know about primary market and secondary market. Like IPOs are in the primary market, and then you have the stock exchanges and commodity exchanges that are like, you know, secondary market. But you go and read about third market, fourth market, fifth market. Okay, electronic communication networks, ECN, pink sheets, etc. We need to, you know, we need to have a lot of reading. Just getting an MSc finance and investment would not be enough. I tell you, not be enough. We are getting into a competition where we will be competing against people who are now having 5 years, 7 years experience, who lost their jobs due to the pandemic and so many other reasons, and due to the fintech technology development. So you are going to compete with all of these. So you have to have a lot of effort put into the reading and learning about all these things. So you see, what you are talking about, that sometimes you negotiate. Can you negotiate with a bank? Okay. Can you negotiate when you are sending your money online? Like I send my money online to Pakistan. So I cannot negotiate. They offer me a rate and I have to accept that. If any one of you is doing trading in stock market, you know, they have the bid and the ask for you. So you cannot negotiate that for you. That comes from your brokerage house. So most of the time it's non-negotiable. Some of the times it is negotiable because of the size of the transaction. But in the dealer's market, they have a bid and an ask price for you. And we call it the OTC market because on one side of the counter is the dealer and on the other side is the client. The client cannot negotiate it most of the time unless it is a third market or the fourth market or something like that. But ideally, this is how it is. We call it the OTC market, the over-the-counter market. So the when you go and sell gold, of course, the dealer again has a gold the bid and the gold ask price for you. The same is for the currency, and the same goes for stocks and bonds that are traded in the market. You have a bid ask coming from the market, the OTC market. Though you think that you are on the exchange, but you're not. You are actually trading on the OTC counter. So over-the-counter market is a dealer's market where you have a bid and an ask. NASDAQ is the most famous dealer's market for securities. I believe all of you know about NASDAQ, isn't it? Yeah, so it is the National Association of Securities Dealers Automated Quotation System, NASDAQ. And if you are trading on NASDAQ, you have bid prices and ask prices from all the dealers who are with NASDAQ, and you can buy and sell the shares based on the bid and ask. So you cannot negotiate the price, and it's a dealer market. The bid ask spread is earned by the dealer. On the other hand, in an exchange market, when you trade, you place an order, like you make a market, or you can make a market order, you can make a limit order, you can make also different types of order, a good till cancel, day order, you know, these are the different types of orders. We will be talking about some of them, but chapter number 2 of the Introduction to Derivatives and Risk Management book, this is what you will have to read for it. Okay, let me just write this for you in the chat. Okay, so it will be Introduction to Derivatives and Risk Management by Chance Brooks, 10th edition, and you have to read chapter number 2 from here. Okay, and also from your portfolio management book, you have to read the chapter on markets also. Okay, now going back to what we were here. So Fahad is saying that it is OTC market is not regulated by law. No, that's not correct. OTC markets are regulated, in fact, quite significantly regulated now by the law. So that's not true anymore. The difference is basically the price negotiation. In the exchange market, you can have your own price at which you want to buy or sell. In the OTC market, you will have to take the dealer's price. Okay, so if the dealer's bid is there, you cannot actually place an order. You cannot go for a price that is different than the bid price offered to you by the dealer. Of course, if you are trading on NASDAQ, you will always go for the best bid and the best ask if you are buying or if you're selling. So please read the chapter number 2 from there, and also the portfolio management book that you studied, whatever the book was. I recommend Rayleigh and Brown. But if it's
How
not
do
any,
we access the books, Mohammed? Because when you go online, you don't get the full. I mean, how do we access them?
you see this book that I have written in the chat, Introduction to Derivatives and Risk Management, you can buy this, and I have uploaded the slides for it, the code for it, 30% discount available. The hard book is not available. The soft form is available, I guess, because as far as I know, the publisher has run out of copies for this book. The analysis of derivatives, the main core text you can find online free of cost. I guess the PDF can be downloaded. It's an old book. I don't know if there are any editions available
Is that
here.
library, like on the library website where you download it?
Yeah, the library also will have digital copies available, so search with them also. You can do it from there. But this one, the one that I have actually given in the chat, I would recommend that you buy this one. It's a lifelong investment. It's something that will help you throughout. Okay.
Okay.
Yeah. It's very valuable book. I learned all what I'm talking to you about, most of it from this book. It's been 13-14 years since I teach derivatives, and I found this book the best. Okay. Okay, so next we move to exchange traded derivatives detail. So exchange traded derivative market will provide you what we call standardization. So the contracts available there will be standardized contracts. Like how many one contract will have how many shares in it. So for example, if I buy one Apple call contract, one Apple contract will have 100 shares in it, for example. So the size of the contract is 100, and this is fixed by the exchange. I cannot go for a contract size of 120 or 130 because the contract is designed and offered by the exchange. So I will have to take it. Like, for example, the Chicago Board of Option Exchange has a contract size of 100 for Microsoft shares. So that will be fixed. I cannot change it. The expiration date, when will the contract expire? So the contract expirations, let's suppose, are in March, June, September, and December. There are 4 expirations. So I cannot go for a contract that expires in April or that expires in July. I will have to actually take the expiration date available that is being fixed by the exchange. And the underlying asset will also be fixed by the exchange. So for example, if I am buying a commodity contract on oil, so which oil? You know, there are different varieties of oil. I mean, we are talking about crude oil. So there are different oil contracts or underlying oil qualities. Similarly, if it is a contract on, let's say, cotton, so there are different qualities of cotton. So a call contract or a put contract on cotton, which quality are acceptable, this will be set by the exchange. Now, interestingly, if I have a contract on a 10-year government bond, you see, the bond is the contract is on a 10-year corporate bond. Okay, the underlying is fixed by the exchange. However, for the 10-year bond, I can get a delivery of any other bond that is permitted by the exchange. So there are variations in it. So the underlying is fixed, but the delivery can be from different qualities of bonds. So it may be even a 15-year bond that is delivered to me. The price will be adjusted accordingly. Then exchange traded trades are guaranteed by the clearinghouse. So what is a clearinghouse? Any idea? What is a clearinghouse? Fahad, hello?
Professor, I'm here.
Yeah. So what is a clearinghouse?
Clearinghouse, it's an agency which settle the contract between the 2 or more parties.
Okay, that's good. So a clearinghouse, basically, you know, as we discussed, there are 2 broad, functions in the market that takes place. One is the price, and the other is the settlement. Okay. Now remember, the trading takes place. Trading. So I'm just saying the trading takes place in the exchange. Okay. But the settlement is arranged by the exchange with the clearing house. Okay. What does this mean? This means that when we trade here, the buyer and the seller, we agreed on the price. And let's suppose the settlement will be taking place 3 months later. Now, in 3 months' time, either the buyer or the seller can actually run away from their side of the transaction. They can default, in other words. Okay. Now, if I am the buyer and I come here for settlement 3 months later and the seller has already defaulted, I don't even know who the seller is on the exchange. Nobody knows who you are buying from or who you are selling to. So I don't know who the seller is, but the seller has defaulted. Now I come here 3 months later, I want to pay money and get my stuff, the commodity or the shares or the bonds, but the seller has defaulted. So I don't need to worry. Why? Because the clearinghouse is there, and the clearinghouse will guarantee that when I come here for settlement, my transactions get settled. So my counterparty is basically, when I say my counterparty is not the counterparty with, like, you see, if I am the buyer and somebody is the seller, when I go to the exchange, let's suppose CBOE, Chicago Board of Option Exchange, I don't know this seller and the seller don't know me. My transaction is basically with CBOE, and the seller's transaction is also with CBOE. So if I default, it doesn't matter to the seller. If the seller default, it doesn't matter to me, because the counterparty here is the exchange. It is not this seller or it is not this buyer. The exchange then does what? The exchange has a clearing house. The clearing house does what? It makes sure that if there is a default by the seller or the buyer, the other side of the transaction is still honored. Okay, so if I come here 3 months later, I want my delivery, I want to pay the money, and the seller has defaulted, I don't need to worry. The exchange is responsible for making the arrangements. So I will pay the money and I'll get the stock or the bond or the commodity. The exchange will then actually use its mechanics to get the recovery from the seller, and that is where, you know, the margin requirements come. So when you are trading in an exchange, there will be margin requirements. So in case the seller defaults, the exchange will use the margin to recover the funds or the losses that it will actually use in the clearing process. Okay, any question on this? Okay, now the next thing is that exchange traded markets are more transparent and they are, you know, more intensively regulated. But, you know, as I told you, that regulations have significantly increased now on the OTC market also, particularly in the wake of the financial crisis of 2008-2009. Now, if we look at the over-the-counter market, the key features include that it is customized. What does customize mean? That the buyer and seller will meet directly. There is no exchange between them. They actually meet directly to buy or sell. Like when we go and we sell our pounds or dollars, what we do is that we are directly interacting with the dealer. So the size of the contract and the underlying and the expiration, every bit of the contract will be customized, will be negotiated between the buyer and the seller. Okay, that is what the OTC market is. Next, the OTC derivative market operates with less regulation and oversight than do exchange traded derivative markets. Now, this used to be the case, but as I told you that this has significantly changed. Still, it is not as regulated as an exchange would be because of the transparency thing that was there on the previous slide. But still, the regulations have significantly increased in the last 1 decade. Like you see, they have actually pointed to that here in this point, that planned regulations may require OTC transactions to be traded through a clearing agency and reported to regulators. And this is what has happened now, that even OTC transactions have now a clearing agency in some markets. And this all has been done to reduce the counterparty risk or the default risk in the transactions on OTC. Any questions so far before we move forward? Okay, so next we have forward contracts, and this is the first type of forward commitments that we talked about a few slides ago. So what is a forward contract? Forget about what we have on the slide here. Anyone? So a forward contract is what? It's an agreement between a buyer and seller where both have the obligation to buy and sell the underlying, and of course the underlying can be a stock, can be a bond, can be a risk-free, can be an interest rate, can be, I mean, like even the weather, as we discussed, at a specified price, at a specified time in future. So you see, it is what? The forward contract is an agreement between the buyer and seller where both have the obligation to buy and sell the underlying at a specified price at a specified time in future. And remember, forward contracts only are traded in OTC. These are over-the-counter transactions. They don't trade on exchanges. Okay. Of course, there is some exception to it now. New contracts have been developed, but we will not talk about it at this point, later on, probably. So let's say A and B agree to buy and sell respectively 100 shares of Apple Incorporated at a price of $125 3 months from now. So you see, this is just an example. I mean, like, just to trying to put those words in the definition into practice. So party A and party B have agreed to buy and sell respectively. That is, A is agreeing to buying and B is agreeing to sell 100 shares of Apple at $125 each 3 months from now. So the time period is 3 months. The price, the forward price is, let me write it as F naught. Forward price is this, and this is T is equal to 3 months. And A has the obligation to buy, B has the obligation to sell. Okay, and the underlying is Apple's shares, and the quantity is 100. That is, the size of the contract is 100. So this is a forward contract. Now what will happen in 3 months time? Right now, let's suppose today the stock price is 120. The forward price that we have set in the contract is 125. This is today. Let's give it T naught. In 3 months time, there are the price is, let's suppose, ST3. The price is 135. So what will happen? 3 months later, A will pay 125, okay, for each of the 100 shares to B and purchase the shares from A, which are worth in the market 135. So A's gain will be how much? On each share, A will gain 10. And if you multiply this by 100 shares, so A will gain $1,000. However, it is also possible that in 3 months time, the stock price is 115. In that case, again, the contract will be honored and the loss will be A will pay B 125 for each share, and the shares are worth in the market 115. So A's loss will be $10 and total loss will be minus 10 into 100, $1,000. So you see, no matter whether A is gaining or losing, both the parties will have to honor the contract because it is a commitment. Both the parties have the obligation. None of the party can run away from this transaction if they are losing money. They will have to honor it. And it's a legal contract, so it is binding. And if any party defaults, that will be a legal default. So you can see in the first case, A is winning as the price goes up. In the second case, A is losing as the price goes down. He will have to pay 125 in each case to B. And if the price goes up, he will win. If the price goes down, he will lose. Okay. Any question on this? Okay.
You mentioned on the clearing in 3 months.
Yeah.
And there
Yes.
is a gain and B defaults. Does it take time? Is it settled immediately by the clearing?
No, because it is an OTC market. So one of the risk of OTC market is credit risk or counterparty risk. So if this party defaults, any party defaults, the other party will bear the loss then. Let's suppose 3 months later, the stock price goes to 115 and A defaults. Okay, so then the loss of B will be 1,000. Is it clear?
Yes.
because B will not be earning anything, whatever he or she was earning, because A is not able to pay 125 because he or she has defaulted. So B will have to suffer the loss then. Okay.
Okay.
That is one of the main difference, because in the OTC market, there is no clearing function available previously. Now there are some available, but it's not certainly not wide. So most of the time in OTC market, credit risk is potential and it can realize. In the stock market or the exchange market, basically in the exchange market, what happens is that you have a clearing house, and in any case, if the counterparty defaults, the transaction will still be honored. Excuse me. Any question other than this? And remember, I have denoted the forward price as this. Okay, this means the forward price that is in the spot market. So, for example, as I said, look at this. This is important because you will get confused with it if I don't clarify it here. Let's suppose this is the spot market and this is the derivative market. Okay, that is the forward market. So in the spot market, Apple is selling for 120. So what is the current price of it? 120. In the forward market, the forward price is 125. And all this is in today. Now, during the 3 months time, let's make it, this is T naught. In 3 months time, what will happen? The stock price will keep on changing till it reaches the expiration date. So the price, as you know, a daily basis, the stock price changes. And let's suppose on this day, it is 135. The forward price will keep on remaining the same. So 3 months later, the forward contract has a fixed price of 125. So it will be not changing. The spot price will be changing. Is it clear? The forward price has a fixed price. That is why forward prices, we say they eliminate uncertainty. So you know with certainty today that in 3 months time, no matter what, you will only have to pay 125 if you are Mr. A, and if you are the seller, that is Mr. B, you will only receive 125, no matter what the stock price here is, 135 or 115.
How do they come up to that price? Because
Yes, that is what we are going to learn in next week. How do we know that the price today should be 125? You're quite right. Okay, that's our job. Pricing and valuation. That's why I said it is a very exciting and I would say interesting topic in finance. If you keep yourself posted and motivated about the concepts and keep on reading, you will see that after week 3, things will start to sort of look very attractive, because you will be able to make sense of the concepts and things that are happening in real world. So here we are. I did this example with you already, but you know the contract is initiated at time 0. The contract is expiring at time t, which is 3 months. The spot price underlying asset is S0. The spot price of the underlying asset in 3 months time is ST. The forward price at t will be, I told you that F0 at T0 will be equal to F0 at T3, isn't it? That's what I just showed you when I was talking about the spot and the forward market, isn't it? I told you that the price is fixed today at 125, and no matter what happens in 3 months time, the forward price would still be fixed. Okay, this is not the case for future contract, but forward contracts, the price remains fixed. We say derivatives are zero-sum game. What does this mean? Somebody's gain is somebody's loss, like in a gambling situation where one gambler loses 100,000, the other gains 100,000. So we saw in our case, for example, when the stock price was 135 and the future price, the forward price was 125, we said that Mr. A earned $10 per share. But that also means that Mr. B lost $10 and his loss was calculated as the opposite of this. So Mr. B lost how much? 135 minus 125, and we put a negative sign because this is what he lost. And when the stock price was 115, you can just reverse this. So if Mr. A is earning $10, Mr. B is losing $10. If Mr. B is losing if Mr. A is losing $10, then Mr. B will be gaining $10. So it's a zero-sum game. Somebody's gain is somebody's loss, just like in a gambling. Okay. There is a possibility that in future, in 3 months time, this price may be 125. In that case, 125 minus 125 is equal to 0. Okay, so here we have an example. Just have a look at this example. Barbara Nix agrees to buy 1 kilogram of gold in 90 days at a price of $38,000 from PM Metals Incorporated, the short party. The short party means the party that is selling gold, and the long party is Miss Barbara here. So after 90 days, the spot price of gold is 38,500 per kilo. Because the price has gone up, so Barbara will be making a gain while PM Metals will make a loss. Because whenever the price goes up in a forward contract, the buyer in the forward contract will make a gain and the seller will lose money. Whenever the price goes down, the forward contract buyer will make a loss and the forward contract seller will make a gain. So here we see the forward price is $38,000 per kilo. The price in 3 months time is 38,500 per kilo. So Barbara will make a gain of $500, the price at which it can purchase and the price at which the gold is trading now. This is the gain to Barbara, and the PM Metals will be having a loss of minus $500. So you see somebody's gain is somebody's loss, and that is why we call it a zero-sum game. Now, future contracts. A future contract is different than a forward contract in the sense that futures are exclusively exchange traded contracts. So they are standardized contracts. The forward contract, as we said, is an OTC contract and it is customizable. However, a future contract is a standardized contract. And the other important difference is that when we talked about the forward contract, we said that the spot and the derivative market behaves like this. We said if today, that is T naught, the spot price is 120 and the forward price is, let me just write this as a snot, is 125. No matter what happens in 3 months time, even if the stock price is 135 or 115, the forward price remains the same, that is 125. However, this is not the case for the futures. So what will happen in a futures contract? In a futures contract, if the future price today is, let's suppose, let's make it T dot, is 125, as the stock price changes each day here till 3 months, let's make it 3 and that as T3. The forward price will, the future price will also change. So for example, it will be changing every day. So let's make it T-0.1. Let's make it like this. So it will be 124 and then future price here T0.2 and every day. This will be, let's make it 1, this make it 0.1, 0.2, and then every day the price will change till we reach here, and it is possible on this day it will have 100 and if it is 135, it will be also 135. If it is 115, this will be 115. Do you understand what I'm trying to tell you here? I'm saying that the price in the future contract will not remain fixed. It will keep on changing every day. As the price changes in the spot market, so will the price change in the futures market. The gains and losses in a future contract are calculated on daily basis, which we know as, if you have come across this term, mark to market. So future contracts are marked to market on daily basis. Unlike the forward contract where the gains and losses are calculated after 3 months, nothing happens within the 3 months in a forward contract. The price in the forward contract remains fixed, but in the future contract, the price will keep on changing every day, and the mark to market will happen every day. So the gains and losses on the contract for a given day will be calculated and adjusted. And the other thing is, when you are dealing forward contract, you don't have a margin requirement, but in future contract, you will have a margin requirement. You will have to put some money into your account, so the daily losses or gains can be adjusted using your margin deposit, and the exchange will add money into your account on daily basis if your future contract makes a gain, and it will deduct the losses from your margin account if there is a loss on the future contract due to mark to market. Any questions? Remember, a fixed price at which the underlying will be exchanged is set by the buyer and seller when the contract is initiated. This agreed upon price is called the future price. However, keep in mind that that price is only fixed for 1 day. When the mark to market happens in the afternoon, when the market is closing, that price is no more relevant. Okay, so for the next day, the price of the previous day close will be used to calculate the gains and losses. And we will have an example to just illustrate this later. Now, as we said, that the future contract is a standardized contract. So the asset underlying the contract, the quantity of the or the asset, the contract size, the expiration dates, the delivery and settlement conditions, the daily price limits, up limit, down limit, these are all set by the exchange. And as we talked about, the gains and losses are settled on daily basis, which we call the mark to market, the daily mark to market. Now, I told you that if you are trading in futures contract, you will have to have a margin deposit. And that is in a way ensuring that the clearinghouse will be able to honor the other side of the transaction in case the seller or the buyer defaults. So the margin works as a performance bond. So the margin deposit, as I told you, will be used to adjust the gains and losses from the daily mark to market. Now, there are 3 concepts related to margin deposit. The first one is the initial margin. This is the margin required when you open the account for and open the trade for a particular transaction. Then the maintenance margin, it is the margin that should be maintained in the account. If your margin deposit go below the maintenance margin, the broker will make a call to you, which is called a margin call. You will be asked to put in additional money into your account. If you fail to deposit additional money, then the broker or your whoever is actually looking after your account will actually close your position. That is important because for risk management purposes, the broker would not want to actually allow it go any further. Now, how much you should be depositing? If your initial margin is, let's suppose, $1,000 and your maintenance margin requirement is, let's suppose, $500, and because of losses your margin goes to $450, okay, that is below the maintenance margin, the margin call would require you to deposit $550 so that your balance goes back to the initial margin of $1,000. This is requirement for derivatives market. In stock market, if it was a stock market transaction, then you would be required to only deposit $50, because in the stock market, you are required to go to the maintenance margin, not to the initial margin. But in derivatives market, the margin call would be to go back to the initial margin. Here we have an example of how this happens and works in the derivative market. So we have a trader here who is going long a future contract at the price of 120. The exchange require an initial margin of $150 and a maintenance margin of $75. The trader deposits 150 into a margin account to open a long position at $1,200. On the first day, the future price has gone down to 1,180. So $20 will be deducted from the margin deposit. So it will be left at 130. The second day, the price goes down to 1,120. So another 60 will be withdrawn from the trader's margin deposit. So it will go below the maintenance margin of 75. So the balance will drop from 130 to 70. The margin, because it is now below the maintenance margin, there will be a margin call from the broker, and this will require you to deposit $80 so that your margin deposit increases from 70 to the initial margin, which is $150. So this is how it works on a daily basis. Depending on the volatility in the market, if the market is considered quite volatile, mark to market may happen more than once in a day. So the mark to market may happen, let's suppose, every 2 hours or every 3 hours in a day, if the volatility increases in the market, and particularly for some type of securities or investments. Any questions so far? Nirmala, you happy with this?
Yes.
Okay, that's good. Now, forwards and futures, a comparison here we have of both. So a forward is an agreement to buy or sell an underlying asset at a later date, and a future is the same. Okay. However, it is an OTC contract and it is customized, and the futures are exchange traded and they are standardized. The forward contracts, because they are OTC, so there is credit risk. There is no guarantee because of the clearinghouse. Of course, we now have some regulations that ask for the clearing function to be there, a clearing agency to be there, and there is limited regulation and reporting relative to exchanges. But as we know that this has been increasing recently. The futures market are more regulated, more transparent, and they have a clearinghouse function also. Then the gains and losses are settled only once at maturity, but in futures, the gains and losses are settled on daily basis. There are no margin requirements for forward contracts. There are margin requirements for future contracts. So these are the differences between the futures and forwards that we have discussed so far.